Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our list of 72 favourite funds, namely iShares FTSE 100 ETF. We previously took a peek at this one in the autumn of last year. This is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and deliver that performance minus its own running costs. In this case, the ETF is tracking the UK's highest profile stock market benchmark, the FTSE 100. In essence, it includes the 100 largest UK quoted firms as measured by their market capitalisation, although there are a few other inclusion criteria too, such as corporate governance and the percentage of shares available for trading. The ETF uses physical replication to provide performance, which means it owns the actual underlying stocks. The largest individual holdings are Megabank HSBC, British American Tobacco, oil majors Royal Dutch Shell and BP, and drug developer GlaxoSmithKline, with another drug firm, AstraZeneca, as well as global drinks giant Diageo, Vodafone and miner Rio Tinto, all following in close behind. One thing to note is the top 10 stocks represent no less than 43% of the assets. So if you buy this index tracker, you need to make sure that you're comfortable with all of those individual stock names. This rather skewed weighting also impacts the sector mix provided by the FTSE 100 and therefore by extension the ETF or tracker fund. Financial services, consumer staples and energy are the three biggest exposures at 21, 19 and 18% of the total assets respectively. By contrast, real estate and technology represent barely 1% apiece of the portfolio, utilities just 3%. The ETF comes with a historic dividend yield of around 4% and dividends are paid quarterly. As a further point, the portfolio holdings are rebalanced quarterly too, in order to ensure that they represent an accurate picture of the FTSE 100 index and its performance. The ongoing charge figure for the ETF is just 0.07%, which is extremely cost competitive. The product's actually the joint cheapest ETF out of a field of 26, while the lowest ongoing charge figure for an actively managed UK large cap equity fund, well, that's around 0.3% a year. This ETF is 18 years old, has a fraction under £6 billion in assets under management, and comes with a 3-star ranking from Morningstar for those who put value in such things. Now, those are the mechanics. The next question is, why would an investor consider this ETF for their portfolio inclusion today? And I think there are 3 factors to consider. The first is that historic dividend yield of 4%, and based on current consensus analyst forecasts, the figure is expected to be around 4% for calendar 2018 as well. That easily beats cash in the bank, easily beats inflation. It also exceeds the yield available on the 10-year government bond, or gilt, which is often used as a benchmark for the so-called risk-free rate, by which all investment returns can be judged. The UK 10-year gilt yield is currently around 1.5%, so the FTSE 100 beats that by 250 basis points or 2.5 percentage points. As we can see from this chart here, a yield premium of around 200 basis points or 2 full percentage points has tended to provide support to the FTSE 100 index, at least in the post-crisis era, even if we must all accept the past is no guarantee for the future. The second reason is that the pound's going down. Around 2/3 of the FTSE 100 index's earnings come from overseas, so the lower the pound goes, the more those foreign earnings are worth when they're translated back into sterling. A weak pound also makes British assets cheaper for overseas buyers. So it may be no coincidence that FTSE 100 members Sky, Smurfit Kappa and Shire have all received bids from overseas companies in 2018. Any further slide in sterling could, perhaps, tempt more predators to pounce. This chart here shows the FTSE 100 against a trade-weighted basket of currencies relative to the pound since June 2016 and the EU referendum. And the latest bout of weakness in the pound, inspired by the Bank of England's decision not to raise interest rates in May, is reinforcing the recent trend of pound down, index up. That means the ETF itself's also done rather well, as we can see here, at least over the past 5 years. The third and final reason to consider researching this ETF is the low cost of diversification it provides. The ongoing charge figure is low at 0.07%, and in exchange for that you get access to 100 firms covering a range of industries, all with great global reach. However, this product may not be suitable for everybody, also for 3 reasons. First, As we've already flagged, the FTSE 100 is heavily skewed in terms of its market cap, income and dividends to just a dozen or so stocks and 3 or 4 sectors. Financials and banks in particular, miners and oils are hugely influential when it comes to earnings and dividend forecasts. And any investor in this particular product must therefore be comfortable with their prospects. Second, although the FTSE 100's dividend yield is attractive, it may not be entirely safe. Forecast earnings only cover forecast dividend payments by 1.7 times for 2018. Although that's still higher than of late, it's below the 2 times cover ratio that really provides some comfort should anything unexpected go wrong. The yield premium relative to bonds looks good too, but if dividends are cut, say in the event of a sudden economic downturn, or bond yields go up because the Bank of England screws up its courage and raises interest rates, then that relationship could also change. The third thing to think about is the FTSE 100's just surged to a new all-time high, as we can see in this final graphic. Generally, the time to buy securities is when no one's looking, no one's interested, not when everybody is. So the fact that the FTSE 100 started this year out in the cold but is now seen as a hot property again could at least give us all pause for thought. What happens if the Bank of England's latest move into interest rate hokey-cokey is to put up headline borrowing costs? That might boost the pound and lower the value of overseas earnings, for example. What could happen if the price of oil goes down again? Would that hit the important energy sector and weigh on the index and particularly its dividend potential, for example? So, when you do your research, it's important that to make sure that iShares Core FTSE 100 ETF fits your own personal overall investment strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.